I have with me Sajid Chenoy, joining us right now from JP Morgan Chase. How well do you follow Arvind Subramanian?
Well, Dr. Subramanian is an excellent choice, really. He's a distinguished academic. He's written extensively on issues related to Indian manufacturing, trade. He's a China expert, has been following India very closely. So an excellent choice, I think, and one that India will benefit from enormously.
So if I look at the choice, Arvind Subramanian, and interestingly, Sir, Arvind Subramanian had been somewhat critical of what the government came out, the Jaitley budget. He said that you're unlikely to meet the target, the fiscal deficit target, unlikely to meet what the revenue projections are. He said that it's a bit of a tepid, policy moves seem to be bland, there's too much continuity. And also, he's been critical of India's stand in the WTO. Despite that, the government has chosen him.
Well, I think that speaks very well of the government. I think for starters in the budget, I think even the finance minister indicated this would be a tough challenge. They would take up the challenge. So I think it's really very heartening to see that you've got all these different views and the finance ministry has chosen the best person for the job. I think the whole idea of having strong independent views internally will make the process better.
All right, Sajid, I want to come to your latest report. You've cut the GDP target, right?
A little bit. I think our growth forecast for this year was about 5.3. We've shaved that down a little bit to 5.1. It wasn't just the fact that the one IP number was weak. I think the fact is exports in the last few months have slowed. The global outlook is much softer now than we had thought 3 or 4 months ago. We have had a deficient monsoon, and that impact will show up in the Kharif production numbers between October to December. And you've got fiscal policy, which will be a drag on growth this year. It's good that we're on a path of fiscal consolidation, but the impact is that will impinge on growth. So keeping these factors in mind, we're focusing on looking at a number closer to about 5.1. But I think investors around the world will not be so fussed about what this quarter's GDP growth number is or next quarter's is. They'll be looking much more at two things. One is what the government does in the coming months, but the fact that oil prices have collapsed, commodity prices have collapsed, and that provides a big advantage to India in terms of the current account deficit, in terms of the fiscal deficit and inflation. So I think from that standpoint, India is quite favorably positioned.
So this is a calendar year 14 projection, right?
This is a fiscal year projection.
Fiscal 15.
So this is for fiscal year 15, which ends in March.
All right.
Yeah, that's right, fiscal 15.
Okay. It's
important because the Jan to March quarter of next year is where fiscal policy is tight.
All right. So are you holding on to your assessment of what is happening, going to happen in FY16?
Well, we believe there'll be an acceleration going forth, but it will be perhaps a little more modest. We're looking at 6% growth. And remember, all of this is contingent on where global growth is going to be as well. We're increasingly integrated. So the fact that China's growth prospects have come off, the euro area is growing slower, there are question marks about whether the US can be an island of growth when Japan, China and the euro area are disappointing. Keeping all that in mind, and the fact that the government's chosen a sort of a 100 small step strategy, we believe that growth will be around the 6% handle at the following fiscal.
If I look at corporate earnings, I mean, I'm just trying to focus a little bit. I'm sure you track that as well. If I look at corporate earnings specifically, corporate earnings come from two broad things, right? One is growth in volumes driven along with growth in pricing power. The second in reduction in costs. Now, where do you think that there is more traction likely?
Undoubtedly, it will be a reduction in costs. So if you look at various factors, I mean, it's clear that pricing power is weak because growth is quite weak at the moment. If you look at where the momentum of core CPI is or core WPI is, that suggests pricing power is very weak. I think the hope is corporates will be able to normalize margins because input costs will drop dramatically. You've had a stable exchange rate, oil prices have fallen dramatically, commodity prices have fallen, and real wage growth over the last 18 months has also moderated quite sharply. So the combination of those factors should mean input costs don't rise as fast. We've seen that in high frequency indicators like the PMI, and allow corporates to normalize margins without having to raise final prices given that demand is weak.
So you're saying that there is a chance of having higher volumes because inflation is going down. So even if real wage is actually starting to taper off, real wage growth is starting to taper off, volume expansion can take place because prices overall are going down, and that could drive a higher revenue as well as lower costs, improving margins. Is that a fair statement to make?
Yeah, well, I don't want to get carried away and say that we're on the cusp of a big industrial recovery. I think there are real issues on the ground. A lot of corporates will tell you that you really need to see evidence of the capex cycle. To be fair, the government's working hard in Delhi to try and reduce some of these implementation bottlenecks on land, on labor. We heard some measures yesterday on environmental clearances, on power and coal. But these things take time to translate to corporates seeing a difference on the ground. So I think a recovery will be slow and gradual, which is okay. But I think if commodity prices around the world come down and stay low, that does two things. One, input costs go up. But the secondly, I think inflation pressures will be more moderate. It will open up purchasing power for consumers.
Yeah.
And like in the US and like in the UK, you should expect to see some boost from consumption.
So would it be fair to say that
continue.
Despite the slowdown, the fact that commodity prices are going down means that corporates might have higher earnings despite lower top line?
That's possible. If and it's a positive supply shock. So yes, if it does translate into lower input costs for a sustained period of time, that can give you higher earnings growth.
All right. I know I've held you up for a long time, but I still have a few more questions. I want to quickly ask you about what you made of the labor reform, the Shram Suvidha announced yesterday.
Yes. I think these are very good initial steps. I think the really important part is the signaling over the last couple of months. This is the second set of these incremental reforms. You had some in August as well concerning the Factories Act, the Apprentice Act, the Labor Act 10. And I think it's a signal that the government fully recognizes that very stringent labor laws are impeding on manufacturing competitiveness. Now, the laws itself, the changes itself are important. They reduce transaction costs for firms. They reduce the intrusive nature of labor inspections and Inspector Raj, if you will. But these are sort of good, incremental, modest steps, very good signal. And now the hope is that the heavy lifting will come in the coming months. And, by the heavy lifting, I mean things like the Industrial Disputes Act, which make it very difficult to fire and therefore to hire, that we'll begin to see some reforms on those areas as well. To be fair, a lot of this is under the domain of the states, and you've seen some states move in those directions. But I think in general, the fact that in the first 5-6 months, we're finally talking about labor market reform, transaction costs, manufacturing competitiveness, these are very important signals, I think, going forward.
Sajid Chenoy, thank you so much for joining us on the show. Pleasure having you as usual.